Welcome to The Explainer. Today, we're diving straight into one of Asia's absolute biggest tech giants right at a massive, pivotal turning point. We're talking about Tencent. We're going to explore their incredibly high-stakes pivot from being the undisputed king of gaming and social media into a fully AI-empowered titan. It's an evolution their own management is officially calling the new Tencent. I mean, for decades, they've ruled social media and gaming in China, right? But now, in 2026, they are literally spending billions with a B to fundamentally reinvent who they are and exactly how they operate. Just consider this frankly shocking anomaly for a second. A negative free cash flow of nearly 14 billion RMB in the second quarter of 2026. Put simply, the money flying out the door to build out their infrastructure was vastly more than the cash actually coming in from operations. Now, for anyone who follows this historically cash-rich titan, this is a massive, massive shift. It marks the very first time in years that the company is burning more cash than it's bringing in. We're talking about a company that usually prints money, suddenly going into the red on cash flow just because they're spending so incredibly heavily on AI infrastructure. So the big question we're answering today is Tencent making a brilliant long-term bet, or are they just overspending in a frantic race to the top? Section 1. The core engine. To really understand how they're funding this incredibly expensive AI rocket, we first got to step back and look at the health of their underlying foundation. Because, let's be real, without a rock-solid core, an ambitious pivot like this simply wouldn't be possible. And what's absolutely fascinating is just how robust their legacy business actually remains. Total revenue hit nearly 205 billion RMB in the second quarter. Marketing services, their ad business, is up a fantastic 22%. And the ironic part? That growth is actually being driven by AI-enhanced ad recommendations, making their placements way more efficient. Meanwhile, domestic games grew by 17%. That totally proves the gaming market is far from dead, especially with titles like Delta Force hitting record-high daily active users. Even fintech and cloud posted a really solid 9% gain. So the crucial takeaway here is that the core machine is working perfectly. When you look past the scary headlines and actually exclude those massive one-time AI compute build-out costs, Tencent's operating profit actually grew by a massive 19%. They are incredibly efficient at generating the immense capital they need to bankroll this huge technological pivot. And they're doing it entirely in-house. No need to dilute equity, no need to take on dangerous debt, just pure operational strength. Section 2. The massive AI bet. With that core engine clearly humming along, let's take a look at exactly how CEO Ma Huateng is deploying all that capital to completely reinvent the company from the ground up. You have to understand, this isn't just some side project. This is a foundational rebuild, and it's happening in 3 distinct layers. Step 1 is infrastructure. They're radically redesigning their physical data centers with their new TAIDC systems. To put that into perspective, regular servers need maybe 6 to 8 kilowatts of power, but these new AI servers, they demand up to 100 kilowatts. It's wild. They are literally rebuilding their hardware reality. Then, step 2 layers on the intelligence. They're aggressively pushing forward with advanced proprietary internal models like Hy4 and the highly anticipated Hunyuan Hy4, just to catch up with some fierce local rivals. And finally, step 3 tops the whole thing off with applications, bringing all of this immense computing power directly to the end user. And that application layer brilliantly illustrates their rapid monetization push. Take the number 21 million. That's the amount of monthly visits their brand new AI workplace agent, WorkBuddy, hit in June of 2026. This is a huge deal because it shows they aren't just doing theoretical backroom research. No, they're successfully integrating AI directly into the WeChat super app ecosystem. They're actively taking the app that practically everyone in China already uses every single day and turning it into a fully AI-powered assistant. Section 3. The cost of progress. Look, transforming an entire tech ecosystem from top to bottom doesn't exactly come cheap. And as we look at the financial impact of all this, we absolutely have to address the giant elephant in the room. In Q2 2026 alone, Tencent's capital expenditure surged by a staggering 176%. That brought it to 52.8 billion RMB. I mean, that is just a breathtaking amount of money to spend in a single quarter on data centers and chips. Naturally, a massive cash outflow like that spooked some investors. They just aren't used to seeing Tencent spend like this, and it recently pushed the stock down to trade around 450 Hong Kong dollars, which is well below its 52-week highs. But if we dig a little deeper, we get a much more nuanced picture. While those headline financials paint this scary picture of a negative 14 billion RMB free cash flow, stripping away the massive prepayments for future AI computing power reveals a totally different story. The underlying core cash flow was actually an incredibly impressive positive 37.6 billion RMB. So what does this actually prove? It proves that this is just really aggressive front-loaded spending meant to peak in 2026 and 2027. It's definitely not some sort of operational failure of the business itself. Section 4. Bull versus bear. So, weighing this insanely aggressive spending against their rock-solid foundation, let's impartially break down exactly how the market is viewing this investment thesis right now. Okay, so on the one hand, the bulls argue that this is a deeply undervalued, entirely self-funding tech giant. It's currently trading at a cheap forward PE of just 13. That's a total bargain for a company of this immense scale, signaling the stock is historically cheap relative to its earnings. Plus, if they actually integrate AI into WeChat successfully, the upside is a completely new, incredibly dominant revenue stream. But on the other hand, the bears raise some totally legitimate concerns. There's definite short-term earnings pressure from all this massive spending. Plus, there's fierce execution risk here. Tencent is racing against absolute heavyweights like ByteDance and Alibaba in the AI space. If they stumble, it's a colossal loss of capital. And you really can't ignore the potential Chinese macroeconomic slowdowns and those ongoing regulatory headwinds either. Section 5. The final verdict. Despite all the near-term volatility and those very real risks we just talked about, Wall Street has largely made up its mind about Tencent's 3 to 5 year horizon. The overwhelming majority of analysts view this as a very strong conviction play. Get this. Out of 45 analysts covering the stock, 40 of them hold a solid buy rating. They clearly see this AI push as a massive positive turning point. And honestly, that confidence is mirrored perfectly by Tencent's own management team. They clearly believe their stock is deeply undervalued right now because they aggressively bought back 300 million Hong Kong dollars worth of their own shares just last week. So as we watch this incredibly high-cost, high-reward transformation unfold, the true test is arriving very, very soon. The highly anticipated launch of their next-generation Hunyuan Hy4 model is expected in just the next 3 months, which really leaves us with one massive question to ponder. Will this upcoming model be the ultimate vindication of this multi-billion-dollar bet? Only time will tell if the new Tencent can dominate the AI era just as thoroughly as it dominated social media and gaming. Thank you so much for joining me for this explainer, and I highly encourage you to keep a very close eye on this fascinating tech evolution.